So let's get started, right? We talk about this market data a lot. We really strongly feel that if we stay on top of the market data, then number one is we consistently understand the trend of how the general market is doing, right, nationally, and in your state and in your local area, how the market is doing, and that's going to help you formulate the right decisions on what to do in terms of real estate, in real estate investments. So on a strategy side, right, it's going to help us formulate that strategy. And then I think in general, it's just good to kind of stay on top of the market. So if the market changes, we can start considering, what actions we need to take to adjust to a change, or we can decide not to do any action. That's also a decision, right? A decision to not make changes, but just being on top of it and kind of being the first to kind of, I guess, stay on top of that market, and also being able to make the best decision. The sooner you have the information, the more time you have to kind of let it marinate and make the right decision. I think that's very important. So from a acquisition standpoint, right, you want to know if it's a buyer's market, a seller's market. If you are trying to buy and it's a buyer's market, then you can negotiate better prices. And if you are buying and it's a seller's market, then that seller has more power. You can do rental forecasting, right? So if you kind of see the right numbers, then it gives you that confidence that rent is rising or stable in the area. It can help you plan exit strategy, right? Should you hold, should you refinance, or should you exit and sell? And then also doing risk assessment, identifying the declining market and avoiding problem area. So a couple of key points, right? So there are 4 kind of main categories. One is your real estate market numbers. There are national numbers, there's regional numbers, there's your local number. We recommend that you really stay on top of your local number. The national, regional, it's good to know, but local number trumps all. And then you have the interest rate. We always talk about interest rate. Interest rate is, I think, on top of most entrepreneurs' minds these days because it has been quite elevated for quite a long time now. And the interest rate really dictates the activity because it dictates the cost of money and the amount of money available for you as well. And then we want to look at some macroeconomic numbers. And ideally, if we can look at those economic numbers in your local market, that's great. What I find is some of these economic numbers are not really available in a lot of the local markets. They are available from a national standpoint. So it might require a lot of digging to get into those numbers in your local market. But just kind of good to know what the national market is doing. And then you have the delinquency and foreclosure data, right? Because that tells us how much distress is in your market. And based on that, it will kind of tell you what kind of inventory you're looking at and do you have good negotiation for these distressed properties. So 4 categories. So let's talk about the first category. First category is the real estate market numbers. All right, we got a couple of these numbers here. You will find that you probably have seen this if you have participated in market update presentations before. And I also have an example here, just kind of put it all together, give you some concrete example of what this looks like. So the first number is the median home price. Okay, median home price is, the kind of the middle. Median means the middle of what the house prices were, right? So that's, if the median is trending up, it means it's appreciating. If it trends down, it means it's going down, right? When you say correction underway, it means it's correcting, it's coming down. Correction underway is just a nice way to say it's coming down. Okay, so we look at that number. That's an important number. One of the most important number though is how many months of inventory. So a general rule of thumb is that if we're seeing less than 3 months of inventory, that means there's not a lot of not a lot of supply out there, right? Not a lot of housing supply. That means the seller have the upper hand, right? They have the negotiation power because there's more demand than supply, and vice versa. If there are over 6 months of supply, that means there's a lot of supply, not enough demand. Then if I'm buying, then I have more negotiation power. And if it's between 3 to 6 months, we call it a balanced market. That's the general rule of thumb. And then I also added active listings. So active listing usually is reflected through the months of inventory, right? So, but if you like to dig into the numbers, right, and see how it gets calculated, the months of inventory is calculated from the average of the last 12 months, or maybe not the average, excuse me, but it takes reference of the sales of the last 12 months. And so there is a piece of if the market has been stable, the months of inventory is a really good indicator of how everything is going. But if there's a sharp change in your market in the past 12 months, if you just look at the months of inventory, the number can get a little bit twisted. So if that's the case, I would want to look at the active listing number to give me a better understanding of how it's doing. So this piece is a little more advanced. So if you're just kind of studying this, months of inventory is all you need to know. If you have been looking at these market data for a long time, then also look at the active listing. And again, it's more prominent, or it's more useful if the market has been moving a lot. There's a big shift in the market. Then you want to look at active listing, and the months of inventory is not the most accurate. Okay, I hope that summarizes it. Okay, and then you also have closed sale, which is what's the sales volume. So if we see a lot of sales happening, that means there's a lot of demand happening. There's a lot of demand. And if the sales volume has been going down, it's a weak demand. Right? And that's another way to say buyer's market or seller's market. If there's a high demand, that means that's a seller's market. Weak demand and supply being the same, right? Then it's a buyer's market. Okay, another really big one is the days on market. It tells us how many days the house sits on the market. So if we see a low days on market, right, the houses just sit there, and they move really fast, that's a high demand. And if it has a high days on market, sits on the market for like 2 months, 6 months, not moving, a weak demand in the market. And the days on market is usually kind of the average of that particular market. So putting all that together, this is a screenshot of the Dallas Fort Worth market. They just they publish this, and they on a monthly basis. So all the graphics is all done right by the local MLS, and they have really good data. So here, just kind of interpret this information. The median price has gone down 2.7%. Okay. So what does that mean? Median price, it's kind of trending down comparing to last year, right? So it says correction underway, right? If we kind of follow that, right? So, but again, we gotta look at it every month through month to make that determination. And the active listing has gone up 14.2%. You can also see the months of inventory, right? It's 4.6 months of inventory. Last year, same time, 4.1. So there's been more inventory. These two numbers should be going in the same direction usually. And then you have closed sales. How many properties were closed? Well, increase in closed sales. That means a high demand. And then you have days on market. Right, days on market has actually gone up. So here for this MLS, they break it down to how many days it sits on the market and then how many days it closed. Right, so it takes 76 days on average to get under contract, and then it takes another 33 days. So if you have a property and you're going, well, I'm trying to sell it, well, it's gonna be the total between when you first list it to closing is 109 days, which is about 3.5 months, right? So something to kind of be mindful of. And of course, if you really want to kind of dive into that, you want to look at the neighborhood that the house is in, so you can really get a better idea of kind of the days on market, because there are certain pockets where the days on market historically in a particular subdivision or neighborhood is like less than 10 days, right? So that means even if the overall general market is not doing so well, and if the days on market in that area just kind of stays pretty steady, then that the flipping a house in that neighborhood, you're not going to hold on to that house for very long. It's going to move really fast. Okay, so to summarize, in general, buyer's market is when we see a rising inventory, increasing days on market, a comment in price reductions, and that is usually a situation that's favorable to investors. Okay, you get better negotiation leverage. On the other hand, for a seller's market, right, you see low inventory, days on market is decreasing, right? So things are moving really fast, and they are appreciating. The price is appreciating. So for an investor, it's harder to negotiate. Everybody is fighting for the same deal. It's hard for you to get a good price and a good return. Okay, next, this is a second category, right? Why do we keep looking at the interest rate impact? Well, every 1% in rate change, there's a study that shows that there's a change of 5.5 million buyer qualifications. So if the rate goes up by 1%, we lose 5.5 million buyers. And if vice versa, if it comes down, then we get more buyers. And then that's gonna drive up the demand. So some examples, right? So we have we follow these news, right? These are kind of real estate IQ news, and also the news that we follow from a interest rate standpoint. Recently there's a Fannie Mae, Freddie Mac, right, buying $200 billion in mortgage-backed bonds, and that pushed the mortgage rate below 6%, right? And then now we are seeing a surge in mortgage applications, right? There are more buyers entering the market. And also that leads to refinance as well. The refinance demand surged 40%. And you got homeowners want to lower the rate, right? If they bought a house or they took out a mortgage at a high interest rate, they want to refinance and lower the mortgage. Okay, next we have macro numbers, and by macro number I'm talking about economic job numbers, right? Employment, unemployment rates, population growth, and all that. So when do I really use these numbers? These are the numbers I use when I decide if I want to hold a property in a particular market. Then I would, do everything I can to kind of look up the employment trends and all that. Because if I'm buying a house and holding it, I'm looking at the appreciation power or the appreciation potential. If it cash flows, great. And if it appreciates and it cash flows, that's really fantastic. So that's what we like to look at. So so let's look at it. If employment, right? If the job is growing in the area, that means there's a steady renters, and also potentially more people relocating in the area. Okay, so these are some rule of thumbs, right? 2 to 3% growth means it's a healthy market. Vice versa, if we're looking at an employment rate of say above 6%, then it's kind of concerning because job loss means less people that are able to afford the rent. We also want to stay in touch with major employers and the development, right? If there are new job or new projects that has kind of long term growth, right? That's favorable for the local market. Or if there's a major layoff or a employer is leaving, that means your future demand is gonna be weakening. So something to keep in mind of. Um, the other one is population growth and migration. So if people are moving in, right, that means you have more new renters and home buyers in the area. If people are moving out, then your market is softening. There are moving companies that keeps track of the migration numbers. So I would usually go to like I think companies like U-Haul, right? These are moving truck companies. They keep track of and publish these numbers on a regular basis, so you can see which market have more people moving in versus moving out. Okay, some examples. Okay, so this is from MarketWatch.com. Okay, you can kind of see on a regular basis, they publish on a national basis, right? The jobless claims, employment report, unemployment rate, and all that. Just something to kind of stay on top of. Again, it's on a national level, right? On a kind of in your local area, you want to find resources that's going to tell you those numbers. All right, and then we also have delinquency and foreclosure numbers, right? If you have a lot of delinquency, all right, that means there's stress in the market. If there's low delinquency, the market is healthy. And then another thing to look at is foreclosure activities, where the volume indicate the amount of distressed inventory in the market. So let me show you an example. Okay, so you can go to FHA, single family loan performance, to see the delinquency numbers, right, on a national basis. You can also follow Real Estate IQ and kind of look at each metro area that we are already in, what the distressed seller leads look like. If we're not covering an area yet, you can request us to go there. We're always happy to serve clients in a new market. And then here you have ADAM Data also publishes their foreclosure activity report by different states. So also something to stay on top of. And we keep track of these too. So if you just kind of stay on top of our website and our market updates, you'll get a hold of this data. Okay, next we got some advanced topic. Just a couple more slides. Okay, so we got a couple more minutes here. So let's look at market cycle and positioning. All right. So if the market is, so there's a market cycle in every real estate and in every local market. If the real estate is recovering, right, it's usually indicated by rising prices, low inventory. You probably want to take a screenshot or take notes here. Low inventory, tightening inventory, low days on market and tightening inventory. Then you can, right strategy is to buy for appreciation, right? Buy and hold. In the expansion phase, right, which means things are, the market is growing. You're seeing peak prices, high competition, tightening supply. You can decide to sell it or hold it. We were talking about wealth building. Is that there's some strategy of just holding and never sell, buy, borrow, die. Something to kind of look into as well. But again, if you kind of want to play the market and be smart about the market, sometimes holding is not necessarily the smartest thing to do. I would say it's the most when we hold, it's the least thing. It's the most if over time holding is the right decision, then it's less work, right? Just less work. You can focus on other things. Of course, there are times where you really want to sell and exit and just kind of pursue a different passion potentially. Then maybe selling is the right way to do it. So everybody is a little bit different. So these are just some strategic recommendations. Contraction, all right? Contraction phase. Prices is declining. Days on market is going up. Inventory going up. So you want to be selective, right? You want to find the right area, maybe the right pockets where you won't lose. And this is the low phase, right? The lowest phase. The low prices, high days of inventory, distressed inventory. For an investor in acquisition phase, right? This is actually not a bad area. You want to bad time. You can buy for value, which is what we usually do, right? We buy it at a distressed price, and we buy for value. So what you want to do is to monitor the months of supply. Okay, most of the time, right? I talk about active listing numbers. Why that's important. But months of supply is just such an easy number to kind of look at and digest. So just a really quick way to decide how the market is doing. So the months of inventory is a really awesome number. And also looking at the pricing trend. So those are the two items that tells you what market cycle, what market phase you're in. And another recommendation is that counter cycle investing. You buy when other people are selling, right? When you're bold when other people are fearful, it beats timing the market. Some real life example, real world applications, right? If the month of inventory is more than 6, and it's high days on market, then it might be a good time to enter, right? To buy. If the rent growth is very strong, and the high prices, right, to buy is high, then we want to rent rather than sell. And if the price is at the top peak, low inventory, low days on market, and we don't see real estate as like a long-term wealth building, right? Just kind of want to make our cash and maybe exit and retire, right? You can consider exit window. And then very important is to kind of look at the market shifting. When the market is shifting, then we want to decide if we want to take action. So you want to watch for the months of inventory, right? Inflection means when it's changing, right? Going up and starting to trend down, or going down and starting to trend up. And that's a time to decide whether we want to take action. So a couple of key data sources, right? National Association of Realtors, your local MLS. This is the most reliable local data. Gives you real-time market activity too. You can go to Census Bureau to look at population trend and migration. And I also shared moving companies, right? Moving truck companies are a really good source to see how the population is moving. And then the Bureau of Labor gives you employment and consumer price index. You also want to stay on top of your local news for major employers and major employment numbers. And then HUD gives you delinquency numbers. And Zillow, Redfin, Realtor.com gives you the historical pricing trends. So these are all really good sources to stay on top of. Or you just join our weekly market update, and we keep track of these numbers for you. So some pitfalls, if you only rely on national numbers, don't do that. Local data is king, right? months of inventory is the single most important metric. The 1 month snapshot doesn't give you the whole picture. I always do compare the last couple of months and also year over year. And if if we are capable of, I like to look at it not just compared to last year, but the yearly trends like that. When we start kind of looking at the horizon, that gives us a much better idea of what the trend is doing, and a more complete view of how the market is doing. And then obviously everybody knows you don't buy at high and at the market peak. You want to buy low and sell high. But sometimes when you're really shoulder deep, right? When you're really deep in the game, and you're getting momentum, and you're seeing the pricing hitting momentum, that could cloud our judgment potentially. So one recommendation is have a regular kind of detaching, detach sometimes, take a vacation. Don't look at things for a while and then kind of come back to it. So the ability to kind of detach can give you a different perspective, or have a consultant, right? Somebody that kind of gives you that advice, and then use your judgment to gauge the advice. So summary, if we always want to know if it's a buyer's market, a seller's market, and you look at your real estate market numbers. And if you're actively doing deals, you also want to look at your local and neighborhood numbers, because it's very real estate is very micro, and also when you live somewhere, right, where you live, that house becomes the center of your universe. And so just when we're buying and selling properties, we want to make sure we keep that in mind, is kind of looking at that as the center of that person's universe, in deciding what the numbers look like and what makes sense. So that's our market update training. I hope you learned something. If you have questions, feel free to ask.